Hey everybody, today we're going to go over a video on support and resistance in the futures market. Now I say the futures market because we're on Optimus Flow. This is a platform for mainly futures trading, but this type of theoretical way of drawing basic support and resistance zones really works on any type of financial asset. So stocks, crypto, forex. It's really just looking at different areas that have acted as previous resistance or support in the past, and then identifying those levels and essentially extending those levels to the right. So in this case, you can see here that we have soybeans pulled up, soybean futures, and what I wanted to really first start with is anytime that you're drawing support or resistance, you really want to use a zone. So a lot of people will just draw very basic lines. So for example here, if I wanted to just draw and highlight a potential resistance zone that acted as resistance in the past, a lot of people will just draw one line. And so if I just make this a little thicker, you'll be able to see it more. So a lot of people just use one exact line. Now, the problem with that is the market is not that precise. For example, you can see here that this high back from March 5th, so I'll highlight this here. This is where we started the resistance zone. Notice how price never got back up to that exact high, that exact top of the wick for that candle. And you can see here that if you follow my this square, you'll see that we did top out here, we topped out here, and then we even topped out here before reversing, either reversing to the downside or at least just finding a resistance zone. So one thing that I really wanted to focus on is instead of using these exact precise lines, you really want to draw things essentially with a highlighter or a very thick marker. So what I like to do, and this is not a perfect science, you can draw these very different ways, but there's a few different ways that you can draw these. So the first way that you can draw it is really connecting the top of the wick and then connecting this this area to the body. So I'm starting at the top of the wick and then I'm pretty much taking it down to the body and then I'm extending it over like this. So the width of the zone is essentially a function of the close from March 5th to the wick. So that's where the width is coming from. Now notice here that you can see that we really barely tested this area on the 2nd of April of 2023. And you can see here when we reversed on April 12th and then April 16th, we didn't come anywhere near that area. So this particular way of looking at horizontal levels is one that, does work. But what I like to personally do is I like to actually take the start of the top of the resistance zone pretty much from the close. So the March 5th close here is where I'm going to start. And then what I do is I'll just simply pull this back to pretty much the secondary close here. So this close on the 2nd of April. So you can see here, now what we're doing is we're connecting this close to this close, the close on the 5th of March to the close of the 2nd of April. And notice now, every single time that we reversed that we were discussing, we did test this general area. And you have to remember that, these areas are not going to be perfect. You can draw them however you'd like. You can draw them a little thicker. You can draw them a little thinner. The width of the zone a lot of the time is a function of what you're looking at. So for example, if you're looking at Bitcoin, Bitcoin may have a 2 or 3% wide resistance or support zone because you have some crazy moves, you have some crazy wicks that occur in Bitcoin and crypto in general, whereas something like soybean futures may not really have that big of a margin of error around these areas. So if you really wanted to give yourself some room, you could start from the top of the wick from the 5th, and then you can pull it down all the way to the close on the 2nd. And notice now you have an even thicker zone that you're watching. And you can see that, we never really got to the top of that zone again. That's why, for me, I would prefer to pull it down to the close on the 5th of March, because if we're looking back, and let's say that we're looking at price in June, if we're looking back, we can see that we never really tested the top of that wick again, so it's not relevant. I want to highlight things that are relevant, and in this case, what's relevant is, these highs right here. So here, 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 here. So when you're looking to the left, i.e. you're looking back and seeing where previous reversals occurred, you want to see where did price respect those levels. And in this case, we never really respected the top of this wick again, so I don't really find that to be incredibly relevant to possibly moving to the upside in the future. So here we're starting from the close. You can see here I'm connecting essentially connecting the close from the second, and we have an area that has acted as almost perfect resistance during during pretty much the 20th of June to the 25th. So this is a great thing to keep in mind, that you do want to really adjust this to whatever you're looking at. Something that's more volatile, you're likely going to have more margin of error within that support zone. And then something that's a lot more kind of liquid, meaning you're not going to have these crazy volatility moves around a level, that's when you may not need to use as much margin of error. Now, one thing that I wanted to point out is, you can really look at these levels not only as previous resistance, you can also look at these areas as previous support. So this is where SR flips come in, and I'll do a video in more detail on SR flips on this channel. But essentially an SR flip is when you have previous support. So you can see here back in February of 2023, you had this area of support. We moved up, we reversed, and we broke down, and then we really started a pretty strong downtrend with lower highs and lower lows. So what you really want to do is you want to highlight these areas that do have this previous support, extend it to the right, and notice here from pretty much from 742 to 750, as we moved back up, this area has acted as an area of resistance. Now, it's not going to be perfect. You can see here that we did slightly move up above this area, but anytime you have a breakout, you always want to anticipate at least a retest of that breakout zone. So this isn't really shocking at all to see a little bit of a pullback in price respecting this 742 to 750 area. Notice I'm not saying 742.50. I'm saying pretty much giving this an $8 margin of error, because that's just what we're seeing. In this case, you can see here, I'm using this bottom wick from the 30th of January, and then I'm connecting that wick pretty much to these bodies here. So that's where I'm getting the width of this area. So pretty much taking the low wick and then connecting it with the bodies here, and you can see from the 5th, 6th, and then the 7th of February, these bodies, which were closes and then the open on the 7th, were all right around this 750 area. So not only is 750 an area that these bodies formed, and pretty much the bottom of the body formed, but you can also see that the 750 is a psychological level as well. So there are many ways to draw these things. The main thing that I wanted to point out in this video is really give yourself some margin of error. Don't draw lines that are literally 750 and 26 cents, because the market just doesn't work that way. You're always going to have margins of error around areas, and price is just not going to respect areas perfectly. So that is what I wanted to highlight. Notice here's an example of if we did continue to break out on the upside, this area 791 to 798 would be the next target above. And notice here what I'm doing, right? I'm just taking the close, and then I'm just connecting that close to the top of this wick. So the close on February 12th and then the top of this candle here from February 13th determines the width of my resistance zone above. So this is something that's incredibly simple, but at the same time incredibly powerful in the markets. Here's an example on corn. You can see here that if we would have simply just used the top of this wick, we would have never really gotten any type of potential reversal signal here. So you would have missed it by $6 or $7. Now, if you would have taken essentially the top of this wick here and connected it with this close, that's when you knew we were getting into a caution area, and that's exactly where we reversed. So hopefully this video was helpful in understanding support and resistance zones in the futures market, as well as any other market that you're looking at. And make sure to check out the next video in this technical analysis series coming soon.